Hello, good afternoon to everyone. Basically, today I'm going to discuss about one of the most fundamental concept in financial management, and that is required for almost all the fields of finance. It is basically the basic knowledge without which nothing can be thought about in various fields of finance. So that is capital structure of a company. Capital structure of a company. What? Okay. So, why I have told capital structure is the most fundamental area? Because capital structure of a company gives us a view that from where the companies raise fund for their operations. Now, in capital structure, in my previous lecture, I discussed about the corporate balance sheet a little bit, and basically I had discussed about the liability side. So, capital structure means we will consider once again the liability side of the corporate balance sheet. What are the major areas appear there, through which the companies raise their fund, right? So let us come to one by one. Basically, capital structure means a company has, in broader sense, two types of capital source. Number one is owned capital. Number two is borrowed capital, or you can say debt capital. Debt capital, right? Now, under owned capital, few things come. Basically, the shares. Number one is equity share capital. Number two, preference share capital. Even number three, reserves and surplus. That is company's reserve fund. Now, these are all means own capital. Now let me explain one by one. What is equity share capital? Equity share capital is basically when a company issues its shares. So those shares are owned by the promoters at the very beginning. when the company is formed, the promoters, they may be individuals, they may be corporates. So, joining hands together, they form or promote a company. Now, if I say that what is a share, means basically equity share. That is, when the promoters are contributing capital during the formation. So, share means here that per unit of the capital holding, per unit of the capital. Now, for example, if I say that total capital during formation of a company is, say, 10,000 crore rupees, contributed by, say, 5 promoters. So their contribution proportion, it can be like, say, 30%, 25%, 15%, then say, how much is 70? 20%, 10%. So, 25, 15, it is 40, 30, 70, 20, 90, 20, 10, 100. That is 100%. Now, if I say 10,000 crore, rupees 10,000 crore, that is the total capital. So, say promoter A, B, C, D and E. He has contributed how much? 3,000 crore. He has contributed 2,500 crore. He has contributed 1,500 crore. He has contributed 2,000 crore and he has contributed 1,000 crore. So, if it is so, and if, say, the total number of shares of the company is 1,000 crore, total number of shares 1,000 crore, that means share value of per share, it is becoming rupees 10 per share, simply 10,000 crore by 1,000 crore. Now the question is, that means we can say that 1,000 crore, that means one share is representing rupees 10. So, 1,000 crore share is representing total 10,000 crore capital. So, I think this is up to this it is clear. Now, shareholders. Who are the shareholders? Again, let me go back to the promoters first. So, when promoter A is contributing 3,000 crore rupees of capital out of 10,000 crore, that means he is contributing 30% of total capital. So, 1,000 crore, if it is the total share, that means 300 crore will be shareholding of promoter A. 300 crore shareholding by promoter A. Then automatically say promoter B was holding 25%. That means 250 crore share held by B. Then 15%, it is the holding of C. Now 150 crore shares are held by C. Then 20% is the holding of D. So D is holding 200 crore share and 10% is the holding of E. So E is holding 100 crore share. Now it is 1000 shares. The division is like this. Now, equity shareholders, they are basically known as the member owners of a company. Now, why member owners? Because I am coming to the individual shareholding pattern later on. Because here you see the promoters, those who are forming the company by joining hands together. That means 30% holding for promoter A means he is the 30% owner of that company. Similarly, all others are recognized as the shareholders to that extent to which they hold the share of that company. Obviously, they are the owners of the company. Now, question is, how equity capital is useful for the company for raising fund from the market? Now, 10,000 crore rupees was the initial capital contributed by the promoters. Now, maybe that the promoters feel that the company needs more fund for doing the business. That was at the very nascent stage, initial stage. So, when the business start progressing, then further capital is required. Now, it is one of the source by using which the company can raise fund from share market, equity share market. Now, when I am talking about share market, basically, share market is the part of total capital market of any country. Total capital market, it has got basically main two divisions, share market and debt market. There are some other form also, broadly divided into these two. There are some other aspects, some other form, that is your commodity market, forex market. So all this, there are combination, but capital market basically at the initial stage, let us understand, just keep in mind that is it is divided into share market and debt market. Now, obviously, equity shares are part of share market. Okay. Now, question is, when the company wants to raise capital from share market by issuing equity shares. So from where those shares come? Because already 100% shares are held by the promoters. In the earlier part, you have seen what I written on the board. Now, question is, then further, how the shares will be issued? You may ask that if further shares are issued, then it will be more than 100%, which is impossible, which cannot be. So, what actually is done? Promoters dilute their stake. Promoters dilute their stake. Now, I am at the very initial stage. There are a lot of things associated with this. Just at the beginning, keep in mind that promoters dilute their stake. That means promoters, they want to release some of their holdings to the share market so that the individual shareholders or other corporate shareholders or say high net worth individuals, that is normal individual and HNI is high net worth individuals, they can become the part and parcel or the part member owner of that company. Now what is happening? Say promoter A decides to dilute his 3% stake, okay, 3% stake. Promoter B wants to dilute 2% stake. So together it is 5%. So initially they have thought that this 5% is enough. So 5% is basically means 5% of originally 1000 crore share. 5% of 1000 crore share. So how much it is coming? It is 50 crore share. 50 crore share. 5% of 1000. 10% is 100 crore. So 5% is 50 crore share. This 50 crore share they want to dilute. What is the par share value? As I told earlier, rupees 10. It is known as the face value of the share. Face value of the share. So, how much they are intending to raise from the market? 50 crore into rupees 10 means total 500 crore. Total 500 crore rupees. The company wants to raise from share market by issuing 50 crore equity share of rupees 10 each, which is the face value, and once these 50 crore shares are issued in the market, it is open for corporates and individuals, maybe small individuals, small net worth individuals or high net worth individuals, to subscribe to those shares. Now there are generally 3 to 4 phases of subscription. Say, first phase is application. Second phase is allotment. Third phase is call. Sometimes these calls are broken into, say, first call and then second and final call. Second and final call. Now, these are the process of collecting money from the investors in step by step. Why it is so? Because, say, if anyone opt for 10,000 shares, then what is the total amount that investor needs to pay? 1 lakh. Rupees 1 lakh. Now maybe initially he is not in a position to pay rupees 1 lakh instantly. So he needs certain breakup payment. Say it is told by the company in the brochure what they have issued. They have told, okay, pay 30% during application, again 30% during allotment, then say 20% during first call and 20% during second call. So, investor is getting an opportunity to pay it. He has to pay 1 lakh. So, 30,000 for the first, then 30,000 once again for second, then 20,000 for first call, again 20,000 for second call. So 30,000 application, 30,000 allotment, 20,000 first call, 20,000 second call. That is for the ease of payment from the investor point of view. This breakup is made. Actually, what happens here, I am giving an example of face value rupees 10. Now, the small companies, they can stick to rupees 10, fine, but the large companies or the big companies, they may take an advantage during share issue, which is known as issue of share at premium. Maybe 8 rupees is the face value. Company may charge 90 rupees premium. premium. This is because of goodwill in the market, what company has built up for certain period. So ultimately, when the company is issuing share, so it is becoming rupees 100 per share. That is the issue price. That is basically the issue price. Now, go back to that breakup. So, if any shareholder wants to hold, say, 10,000 share, that means 10,000 into 100. So, 10 lakh rupees he has to invest. So, 10 lakh rupees, it is not a matter of joke to invest at one point of time. That is why he can pay rupees 3 lakhs per application, 3 lakhs per allotment, 2 lakhs for first call, 2 lakhs for final call. In this way. Now, what happens when the company is issuing the shares in this way? Then this portion, okay, this portion, that is rupees 10 per share, this portion, if it fetches around 50 crore total issue of share multiplied by 10, that is 500 crore, this will go to share capital account. And 90 rupees per share premium. So 90 into 50 crore, that is how much it is becoming? 4,500 crore is going to share premium account. Now, what the company is getting extra? This portion. This portion is company getting extra, which goes into their reserve. So, company's share capital is increased, plus company's reserve is also increased. Now, question is, if that shareholder who is holding, say, 10,000 shares, he may claim that I am the owner of that company to the extent of 10,000 by what is the total number of shares issued? 10,000 upon 50 crore. He is the shareholder to that extent. Right? Now, question is, what for this investor will invest? What is the interest? There are two types of interest for investing in equity share. Interest one, that is dividend receipt. Number two, capital gain. Capital gain. What is dividend? Dividend is nothing but the part of profit. Part of profit of the company. How dividend is issued? What are the legal clauses, rules? Those are different area, vast area. But dividend is paid to the investor as a return on their investment. Say if I invest anywhere, why should I invest? Investment means definitely is associated with certain return. So dividend is the return to the equity shareholders. Now, I am coming to the dividend part in a little bit detail. But before that, let me tell the second one, capital gain. What is capital gain? Capital gain is, suppose that shareholder has invested in the equity share where the par share he has paid either rupees 10 or rupees 100, whatever it is. If it is issued in premium, then rupees 100. If it is issued on face value, it is rupees 10. Question is, now what is the process of next step of share issue? Just the company issued the share in the market and they have raised the fund. That is not the end. The company, after closing the issue process, which is generally remain open for 4 to 5 days, after that, within a month, company has to get enlisted in any exchange. This is called listing. Two most common exchanges, what almost everyone knows nowadays in India, they are BSE and NSE, Bombay Stock Exchange and National Stock Exchange. Now, once the company is listed, then the company's shares are permitted to go for trading. Trading means buying and selling freely. From that point of view, we can say that when shares are issued originally, they are issued in primary market. Primary market. And after listing, when they get the permission to be traded, that market is known as secondary market. Now, when these shares, issued shares, goes in the secondary market, they may be traded. It's very important. They may be traded either above their issue price, or in few cases even it may be traded below their issue price. So after investing in the primary market, once the shares go to the secondary market for free trading, then the investor may go for selling the shares if he or she finds that share market is in a very good condition and the share after listing and when it becomes eligible for trading, the share price is around say 120 if the face value is 100 or say rupees 12 if the face value is 10. Then it may happen say within a month depending on the company or within 3 to 4 months if the share market is booming in a very good condition. So let us assume the share market is a good condition. So if he sells it say rupees 120 per share when he has invested rupees 100. So per share he is getting rupees 20. Now if he holds 10,000 shares, that means straightaway it is 10,000 into 20, that is 2 lakh rupees. He is gaining, that is known as capital gain. So capital gain is nothing but the difference between the sales price and purchase price. Now, if the share price instead of 120, it goes down to 90. Now, obviously, there is no fool in the world who will sell those shares at rupees 90. Unless and until there is high emergency for the fund. So, in case of high emergency, even the investor may think of selling those shares at 10 rupees loss per share. But generally it is not the case. Generally, except high emergency. So then shareholder will hold back the shares and will wait for when he will get a reasonable margin per share. That is say 120 or 125, 130 like that. Then if he wants to book the profit, it is known as profit booking from the investor's point of view. If he wants to book the profit, he can sell it in the share market and can book the profit straight away 30 rupees per share, or 25 rupees per share, 20 rupees per share. And generally in the among the investors, we find there are two types of investors. Age-wise, those who are young age investors or even at the middle age group, then the risk takers, means they are ready to take risk. So their main target is capital gain. That is their main purpose of investment in equity share. But if the investors are old, post-retirement, they may require regular income. So, they will prefer dividend receipt on a regular basis. But anyhow, there are dual purpose for investing in any equity share. And there is a third part also. That is, the equity shareholders have their voting rights in company's annual general meeting or extraordinary general meeting, whatever it is. Voting right means when a company is taking decision, fundamental decision for the growth of the company or for the betterment of the company, or at the time of say any emergency situation, they have to pass the resolution in annual general meeting or extraordinary general meeting where the shareholders are shareholders remain present. Now, if you think that really it is good for the company what the company's board of directors or say the key managing persons, those who run the company on a day-to-day basis, if the investors think that it is good for the company's future, they will definitely vote in favor of the resolution, or if it is reverse, they will vote against the resolution. So this right can only be exercised by the equity shareholders. Obviously, say if you are holder of say Reliance Industries share to serve say sizable amount. If you are the holder of Tata Steel shares, sometimes it even adds to your social prestige also that you are the holder of a good number of shares of those reputed companies. Now, basically, this is the equity market, and this is the way by which the companies can raise fund by issuing equity share. This, whatever I have told till now, it is basically at the very nascent stage, very initial stage. The process is very long. Process is extremely long. I just have told for the beginners to understand how companies raise capital from equity market by issuing equity shares. Now there is another share which is number 2, that is known as preference shares. And from the name it is clear that these shares are allotted on a preferential basis, not to everyone. It is not for everyone. It is allotted on a preferential basis. Now, preference shares have got 2 characteristics. It has got part characteristics of share and part characteristics of debt capital, which I will cover up in my next lecture. Debt capital. Now, why? Initially, you should know, just for your knowledge, that preference shares bears fixed rate of dividend. Say 14% or 12%, like this. Fixed rate of dividend, which is the general characteristics of the debt capital. You think that when you are taking loan from a bank, then you are paying interest at a fixed rate. It's not like that the bank may charge interest as and when they think it fit. Sometimes 10%, sometimes 12%, sometimes 18%, sometimes 9%. It is not like that. You have to pay interest at a fixed rate. So from that angle, it is preference share has got the characteristics of debt capital. And from share, why it is partly bearing the characteristics of shares. Like an equity share, dividend payment is not mandatory. Very, very important point. Dividend payment is not mandatory in case of equity share. But preference dividend payment, it has got certain rule. That is, say, preference dividend payment is not mandatory every year. But if consecutive 3 years company fails to pay preference dividend, then all these 3 years preference dividend gets lapsed. Okay, and fourth year it is considered as again the first year. That means these characteristics is matching with the equity dividend, where equity dividend payment is not at all mandatory. But there is one point. That is, if the company wants to pay equity dividend, then obviously they will have to pay preference dividend first. Then only they can go for payment of equity dividend, otherwise not. Otherwise, companies are not permitted to declare equity dividend. So say, if the company hasn't paid preference dividend for 2 years and they have decided to pay it in the third year. So for the first 2 years when the company hasn't paid any preference dividend, they are not permitted at all to pay any equity dividend. Only after payment of preference dividend in the third year, then the company is permitted to declare equity dividend. That is very important point of differentiation. So preference capital, basically it is also a way of raising fund from the market, capital market. But since the preferential allotment is made here, not to everyone, like equity share, that's why the name is preference capital. So two sources already we have got in the capital structure. One is equity share, one is preference share. Now, let me tell about debt capital. Debt capital, for example, companies may issue debenture, companies may issue bond. Even when the companies go to banks for taking long-term loan or even short-term loan, all these are coming under debt capital. So debt capital has got two divisions. One is secured loan, another one is unsecured loan. Now these two has got a meaning. Generally, when the companies are issuing debenture or bond, companies have to keep their fixed asset as a backing for the investors in case the company winds up. Companies become sick and decides to wind up. So by selling those assets, the secured loan providers, that is debenture holders or bond holders, they will have to pay back by the company at the very first priority. Even from the banks, when the companies are taking loan, long-term loan or even short-term loan, companies has to keep certain asset as mortgage. And the reason is similar. That is, those mortgaged assets, the banks can sell off in case of company's inability to pay back the principal amount plus interest amount to the bank to recover certain percentage of their loan, or in some cases they may recover even 100% by selling of those mortgage assets. That means secured loans are always backed by the asset. That is the characteristics of secured loan. And it is the company's responsibility to pay back to the debenture holders or bond holders or the banks as the first priority when they decide to wind up. They are the first claimant for their investment. Unsecured loan, on the other hand, generally if the companies take loan from their closely held field or from the group companies or sister companies, sometimes there is no need to keep security backing. So in that case, it is unsecured in the sense company may or may not pay back in case of wind up. Obviously, unsecured loans are risky comparing to secured loans. Secured loans are more or less secured. So there is, say, another example. Perhaps you have heard about companies' fixed deposits. Fixed deposits are all unsecured loan, and that's why you will find that whenever you invest in companies' fixed deposit, you will get pretty high rate of interest. Because company has to pay a high rate of interest, otherwise why will invest in unsecured loan where the recovery of your money in case of any debacle, it is under question, right? So secured loan, unsecured loan, they comprise the debt capital. It is the second primary source of raising fund for the companies. And apart from that, the last one in the capital structure. So in the capital structure till now, what we have got? Equity share capital, preference share capital, secured loan, unsecured loan. Now for debt capital, there is one more important thing, that is companies have to pay interest. Very important point. Companies have to pay interest irrespective of profit or loss earned during that year. Like when you take any loan from bank, personal loan or car loan, house building loan, you have to pay interest or EMIs. From anywhere you have to arrange the fund. So it is same case. Company has to pay the interest irrespective of profit or loss. Now, the last part, which is absolutely company's own control, which is under own control, company's own control. That is the reserves and surplus. These are absolutely company's own fund. Now, sometimes it happens that a company is overexposed either in the equity market or in the debt market. That means company has taken very high quantum of loan from the banks, so banks are not ready to give further loan. Even the company is not permitted go for debenture issue or bond issue because of their shortage of proper asset backing. Even the company cannot go to the equity market because of this high exposure of loan. The equity share issue may not be successful. In that case, company may use its reserves and surplus fund. If there is a project, profitable project comes to the company, so the company will use its reserve, that is general reserve, or basically from general reserve, company will supply the fund. And what company prefers in case of overexposure not to go for loan, further loan, because either even if the bank is ready to pay the loan, they will charge exorbitant rate of interest, high rate of interest, which is not profitable for the company to go to that extent to cover up their risk of recovery of capital, recovery of loan, or with high exposure, loan exposure, company may lose the control in case of total failure of repayment. If the loan exposure is very high, sometimes the loan providers, they may take control of the company management. They may they may enter into companies. They start poking their nose in companies' day-to-day decision making. That is not at all desirable for the company, right? So for loan, there is a limitation. For share, if there is overexposure, they cannot go to the share market. So then they use basically the reserves and surplus. So all these five comprising equity share, preference share, reserves and surplus, secured loan, unsecured loan. these 5 actually bits of the capital structure for a company. And for the first 3, equity share, preference share and reserve surplus, these 3 generates the owned capital for the company, and secured loan, unsecured loan, they provide the debt capital of the company. All these are long term. Capital structure means here it is long term in nature, not short term. That is very specific. You have to remember it is very specific. So this is all about the capital structure of the company, at least for today. And in my next lecture, definitely I will show you that where is the danger for excessive debt capital. But without even debt capital, the company cannot run its business. This is very interesting in here. Overexposure of debt is risky, but without debt capital, in fear of risk, if the company decides that I don't want to go by debt capital, then company will not be able to make profit at all. So in my next lecture, that I'll try to explain. So for the time being, till now, goodbye, and hope you have understood what I have tried to explain. Thank you very much.